Hello, everyone. Welcome to this new episode of the Fundraising Insiders podcast. This is our first podcast in person, so it feels quite special. I hope that the whole setup is fine. And I am today with a very prestigious guest. I'm very happy that we actually met the first time in person and we're seeing again each other in person. I think there is no one better to introduce yourself than yourself. So I'll ask you to introduce yourself. What is your name? What is your role at the moment? And what is your academic background?
Thanks, Thibaut. Great to be back in Monaco. Yeah, my name is Vivek Dogra. I come from India, started my life as a beer salesman, moved very quickly to Singapore. Today, I'm the co-founder and a general partner in DDF. It stands for the De-Fossilization Development Fund, registered in Luxembourg, and the team is primarily in Switzerland.
And so in the pre-recording, you were telling me about a little bit of the thesis of the fund,
exactly.
So where you're investing.
We are emerging to be a player in the, let's say, generally known as sustainable finance, climate tech, climate investments. We are an Article 9 fund, so which in the EU taxonomy really stands for a dark green fund, which means any investment we make is not just climate tech, is not just nice to have, but a must have. So it has to have a measurable impact of emissions on something which can be concretely measured.
Right.
Yeah, it's either in terms of let's say what is broadly called ESG, and most funds only talk about the E part. So in the E part, yes, you have to have measurable metrics on the impact on the planet. But we also believe in this philosophy of, let's say, the 3P model: is planet, people, and profits. So planetary health is directly linked to people's health. And of course, to our investors, we need to return their fair share of the profits. So this is where we, it's the intersection of these three that we work on.
I feel like this is something that you fortunately or unfortunately realize when you're in the climate journey, coming as a climate founder. No matter how much good you want to do in the world, if there is not the profit aspect, then suddenly you remove the financial sustainability. And I feel like this is something very often is understated about sustainability, is it needs to sustain itself in time. And we happen to be in a capitalist world, for the best or for the worst. This is not a philosophy podcast, but if you don't have that financial sustainability, then suddenly everything disappears. So I guess this reflects in the 3Ps philosophy. And then I feel like it's beyond a pledge. We often hear about ESG policy in big companies. Large corporates can be a subject to that. And we'll tackle the topic of corporate money, where some ambitions are taken and very often pushed to 5 years later. How are you making sure that the Section 9 of the fund actually gets respected? How do you not only set a vision, but actually apply it, set boundaries? Is there anything that limits the fact that you could stir away from that? What are the safeguards around it?
So it starts at the very point that we are doing the analysis. We are analyzing, doing the due diligence on the company. So do they already have measurable metrics? If not, we bring in our know-how, expertise, so also what we have learned very closely working with the authorities in Luxembourg and Brussels under the EU taxonomy, and how to report. So this is actually one of the important things which differentiates an Article 9 fund from the others. It's a reporting, the measuring, and also measurable improvement. So if they are not doing it today, so it's not just nice to have as you make your first investment and you invest at the first stage, but over the holding period, if you hold the investment for 5 to 8 years, year on year, what has been the improvement in those metrics, whether it's tons of CO2 saved, of emissions saved, or the amount of plastic removed from the environment, or let's say fossil fuel-based chemicals used in the value chain, the amount which have been reduced and replaced by bio-based materials.
And I guess the first part, if you have to measure something, you need to know what you're measuring. Otherwise, you're not tracking anything. How do you set those? Because they're KPIs, right? How do you select the right KPIs, and how do you make sure that the company doesn't only select the one that arranges them? Because very often we end up with, I think, a bit of a CO2 vision where, it reduces CO2, it's a good impact. And outside of that, you mentioned forever chemicals or fossil fuels or other things that could be increasing or with a negative impact, but the CO2 is going down. So how do you make sure that you track the right KPIs and you don't forget one of them or omit one of them?
I think there is, it's horses for courses here. Each company, each startup, as it's looking for funding from entities like us, has a certain concept. It's based on the technology. It's based on the materials. We really like to call ourselves not an agri-food or a packaging fund. We are not focused on a particular sector, but it's really about materials.
Right.
So it's about materials is where in the value chain, what are the ingredients? What is the input feedstock? Is the process know-how? How are you converting it? And what is the output? At the end of life, what is the end of life? Life cycle analysis, as it's called. What happens? Is it degraded? Is it biodegraded? Is it industrially degraded? Or will the consumer biodegrade it at home? So for each company, the concept, you need to analyze it a bit from the commercial angle, obviously, but the starting point is normally the technology.
Right.
It's the material handling, the conversion, and then the impact. Each one, you need to find the right measures here,
Right.
which are comprehensive enough so it captures everything which is in the value chain of that company's operations. So down to even using, is it the energy they use, is it renewable or not?
So really full LCA.
It's a full LCA
Start to
analysis,
end.
but then bringing in the, let's say, if you think of it as few bubbles coming together or a Venn diagram, whatever you call it, the commercial aspect analysis, the technology aspect. There's no point of having a technology, but it requires such huge input costs or very high usage of energy, which is being used from the grid. And then you say, this is the impact on the environment. And then, of course, is the environmental aspect itself. So all four need to be balanced in some way or the other. But the metrics you use or you create around this particular company should be comprehensive enough so that everything is captured, but also not dogmatic, that you do it in a way that you kill the entire concept.
The business.
Exactly. And typically, as I would like to highlight, we are a growth stage investor. So in most cases, the company has already commercialized their product.
You're mentioning some revenues.
Exactly. They have already moved from a lab scale, from a bench in a lab to a pilot plant, and ideally moving from a pilot plant to a full scale industrial. When they move from pilot to an industrial scale, is it everything in-house? Is it all CapEx, or is it using existing plant, existing machinery, contract manufacturing? All of this is possible. And therefore, it makes it a bit more viable in the medium term. Long term, yeah, everybody would like to build their own factory, their own plants, and have huge CapEx, but it's not always the case. So then it's really a question of what are you capturing, really? What are you capturing, and are you missing out on something? Now, to give you a very fairly simple example from a consumer perspective, you might argue today, I should move to an electric car. So, but do you already have a car? If you already have a car,
are you
going to destroy it and buy the electric car today? Or would you want to run your current car until the end of life of that car and then switch to an electric car, in which time, if it's 3 years or 5 years down the line, the electric car technologies would have improved further, and you would have not made the adverse impact on the planet by destroying your current car.
Unless you sell the car, and in that way, you're kind of offloading the usage, the end of life of that car to someone else.
But then the question really is, to someone else is still on the planet. But are you putting something new in the market, into the planet, into usage, while it existing as it is still there? So you need to, it's the same thing we could discuss when, we're having a coffee now. So a paper cup versus
ceramic.
Ceramic it'll be washed again, but then you'll have the detergent, you'll have the water usage, but then it'll be used again. For the paper, yes, you will destroy one more tree. I mean, you will take, but it's a renewable resource. So you need to do,
provided the resource is a controlled forest with all of that going.
Exactly. Right. So for any new idea which comes onto the market today, you need to look at what is it replacing, right? And is the replacement still valid? The current technology, the current value chain still valid? And is the new one, for sure, the new biomaterials, this is what we're pushing for, but what would it replace, or would it create something new? Back in business school, my ex-professor, very well-known person, unfortunately is no more, used to say that each new business idea, you need to think of it either as a vitamin or a pill. Either it is improving an existing process, or it is solving a problem. Vitamin is giving you a boost, or a pill is solving a problem. You need not always have to solve a problem and the problem doesn't exist, but it is giving a boost. It's a vitamin to an existing business model.
Do you feel like some companies get this confused where they think that solving a boost or creating a boost is solving a problem of what is virtually inefficiency? So if you say that I'm buying a new car because my old one either doesn't satisfy me anymore or I'm going to have kids. So I need a bigger car and the car is still functional. Then the problem you're solving is the inefficiency of the current product. How do you balance the weight of the impact of putting a new product where the other one already exists versus solving the problem of the first one's inefficiency? For all I know, we could still have very inefficient cars, all of us, and they're still working, but we will thrive towards more performing ones. But that means replacing a product that's already there. So how do you weigh those two things out, the improvement versus solving the inefficiency?
But yeah, again, as I said, no one answer, no one size fits all.
Of course.
For each pitch we receive, each idea we discuss with the founder, we see the current business, where they are, what has been the real motivation, what is the problem they're trying to solve, how will it scale up, what would it replace, how would it impact people's lives, in what region. So sometimes you can look at things by geography. Maybe you're on an island, it's a different thing. You don't have the natural resources around and therefore you're solving it. So I know, for example, some islands just ban a complete ban on plastic or single-use plastic. Could be a solution. But then is the replacement heavier? Are you going to ship, glass bottles and bring back, or are you just going to improve the water supply in the place? PET recycling has been a hot topic. Plastics in the ocean has been a topic. But if it's being recycled and there is a premium, and are the manufacturers paying the premium for the rPET, the recycled PET, is one way. You tax the plastic, you generate the revenue, and with the revenue generated, you create the reverse logistics. You create the capture of the used plastic, bring it back, recycle it.
To create an rPET chain that is actually cheaper, because right now it's not really affordable.
Or you create, bioplastic, or just look at alternates. Glass, yes, it's more sustainable, but it is also operationally more expensive. So, and then are you using fossil fuel to ship glass bottles and bring back glass bottles and so on, and for heavier things. So it's always comes back a bit to the LCA and the value chain of the company end to end, particularly in which geography and what is availability of financial resources in that area. And in some ways also how evolved are the communities and the local government. So most of the things, in fact.
So that's for the adoption part. So that's already diving into market dynamics.
Yeah, you come back a bit to public-private partnerships. So how is the community, how is the local governance in place, and who benefits,
I see.
We have seen examples, here in Monaco now, free shuttles. There's this, whenever there's a big event, free shuttles going around. Why cannot there be free shuttle buses all year round, so that you don't have the problem of pollution, cars coming in, a lot of land space being wasted with the cars and car parks and so on. And then you balance that with what is good for the community versus also what is good for
the economy
and
the environment,
personal preferences and individual preferences and so on.
I think the reason why I think you're such an interesting guest is because so I wrote it down here. We have those 4 types of money that you've been involved with since the start of your career. You've your venture partner at ECBF, which is the European Bioeconomy Fund. So this is what we call here the so-called public money, because although the ECBF is a venture capital fund, the LPs in that case are governments.
The anchor investors.
The anchor investors are government or public money. You spent, I would say, the majority of your career at Nestlé. So this is where we'll tackle the corporate aspect and the difference with that. CVC versus VC. We have your work with Ceres AgTech, which is working with uni spinouts. So now we're talking about academic aspects, which might differ from other projects. And finally, which is the most actual one, DDF, your De-Fossilization Development Fund, which is more recent. Let's work actually back in time. Starting from today, you mentioned that you were investing in companies that had already some revenue, and you put a point on the fact that everyone wants a factory. It does sound cool to have a factory, but it might not always be the best thing to do. How, because we also address a public of early stage founders or people just at the ideation stage, how do you know early on whether you should orientate your capital strategy, say, whether you're going to raise a first round, second round, third round, so thinking about the dilution towards building a company, so high CapEx, not necessarily from VC funding, it can also be debt or whatever, versus third party offsetting. I believe a big part of that is also the IP protection, especially when it comes to materials. People are scared of taking that to a third party. They feel like the material or the formula, the process can be stolen. As an early stage entrepreneur, how do I know which direction I should go between building my factory and entrusting my production to a third party?
I think it's been said many times. Of course, we invest in teams and we invest in the founders, and we believe in the kind of passion and the vision and the differentiated team, not one person alone, but also, it's always a team. Now, back to your question, as a founder, what would be good advice for a founder coming from the VC perspective is that, are you clear not just at the early stage, of the next 1 to 2, 3 years, you have the proof of concept, you have the product or service in the market, you're moving from pilot to bigger, but are you really focused? Have you thought through all aspects as you scale up? Now, it's always interesting to have a CapEx-light model. There are existing assets, particularly in the kind of food packaging area that we talk of. There are always converters. There are existing manufacturing capability. There is contract manufacturing available.
Yeah.
But have the founders chosen their markets well? The common term is a product market fit. The product in which market do you want to start? One country, new country in Asia, one country in America. What will be the value chain, as we said earlier? The input material. Where would you source it? What would you process it? Who will be your customer? The paying customer. Is it one size fits all, or will you adapt a bit market by market? And then I think a bit of a hidden thing is there is a lot of state support. These days, everybody around the world, at many cities, in a way, in some cases regions or cantons, as we call them in Switzerland, are also competing with each other to be seen as innovative cities, or cool cities to have founders and startups. So here in Monaco, but across Europe, Berlin in the recent past, more recently, I would say Copenhagen or Amsterdam, and within Switzerland, you have
Trace this. I believe bioplastic company had a huge amount of money from the government to build their first factory. I think that's a demonstration of that.
Yeah. So you get local regional governments are supporting in some ways taxes, creating the infrastructure, creating a network. So you choose where you would want to produce and which is your, where is the market going to be. So choose in some ways, and this is where I now wear a bit of my corporate hat. Do you want to work closely with a large corporate in the sector that you are in? Is it agri-food or packaging or personal care? Do you want to connect a bit with the larger players, and need not be, then again, are you a B2C? Are you going to be a consumer facing company, or are you going to be a B2B or B2B2C kind of company? Will you create something which will then be picked up by the large corporates? So these are things to think about. And is your technology completely differentiated? We always see on those pitch decks, share of the market, the size of the market, etc. How clear is it? How can you really drill in and say, this is the share that I will take, or I'm going to create something completely new? But then eventually, you need to be super clear who's actually going to pay for your product or service. Is it a large corporate, or is it the consumer? And what is it that how your thing is so differentiated? Will they switch if they were to spend their money onto your product or service? What will they not spend the money on? Is it an existing thing, or is it something completely new? Yeah, I think these are really the models to think about. Production, will it be CapEx heavy, CapEx light? Local state support, tax grants, some debt, public funding available, really leverage there where possible, but then be super crystal clear on where the revenue comes from. What is the revenue model? So most people, when they talk about business model, is actually about the revenue model, where will the revenue get generated? And if it is so attractive, why have others not done it before? Do you really have Do you really have a differentiated technology never been done before? And I'm really talking of consumer goods. This is my background. I'm not in deep tech. We are not, our fund is not in
software,
tech, software, etc., which has a different slant to it. My own take is that for these products, we are talking of food, personal care, etc. There's a touch and feel aspect, and the scale up also comes with other aspects to think about: regulatory approval, country by country, safety. Is it going to be safe? Cultural nuances. What is something very light in one place is maybe may not be done completely different in Asia or Latin America. Whereas in tech, the scale up can be very rapid. The initial thing, the iterations can be fast, but you create one new software and overnight you can launch it with very little cost. But for the areas we are in, the scale up, is not commensurate unless the volumes pick up dramatically, and then you start to look at full scale production of your own.
Is margins a big determinant of which strategy you're going to adopt? I think a lot of materials company, especially when it comes to commodity or food, you're looking at very often coming from the plastic field, but in other materials, very slim margins, which are the things that usually tend to justify, at least in the earlier stages, having your own pilot, having your own factory, because you can derive, although you have a high capex upfront, you can derive more value out of it than going with a third party and only getting a slimmer portion of that already slim margin.
Yes and no, but you also need to get to the point that you say, now I'm going to really scale up. And for that, you need to have, let's say, pilot production with outsourced, with CapEx-light model to prove it. But then the point is very valid, so a lot of the margins are actually in the retail business. So how do you manage your retail channels? There's a huge thing over the last 10, 15 years about direct to consumer. So you can sell through the web.
So D2C.
You can sell through e-commerce channels. You don't need the retailers. And then in the retail environment also, it's getting more and more consolidated. It was more fragmented earlier. Now you have either top end premium retailing versus the private label and hard discounters, as a channels. And this is becoming almost global. It's the same thing. On the other hand, you can argue there's no big thing about buying for a Gen Z, buying a 5, 6 or $5 to $10 equivalent coffee. It's just a coffee. Versus then going to, you can buy a full, one month of coffee in a hard discount for that price. So it's really what the value appeal is,
So understanding the market really comes down to that. So exactly targeting that. We have those different types of money. You have been involved from anything to the lab when you were in your corporate world to growing seed, Series A, and now looking at more Series B growth. Are there different pots of money? Are there different types of money that you should take at different stages? And is there kind of a rule of thumb, say, if you want to develop anything in the lab, then VC money might be a better thing to look at. Once you're starting to expand into a new geography, maybe the ECBF can help you to get into a new geography because of the public aspect of it. How about, you mentioned debt as well, grants, maybe grants come earlier. Can you run us through sort of the different types of funding and how to adopt them and when?
Yeah, on early stages, I've seen on both sides, from the corporate angle, it's really the R&D budgets.
Right.
So R&D budgets are typically R&D accelerators, internally led. Most large companies have created it. Also external led, which has been the model with some of the FMCG companies.
Right.
To work closely, you don't assign your own people into managing a large portfolio, but you work with an external agency, and they filter, they scout, they create an event, they do the pitching sessions, and then they support, and then you can choose to take an option into the company. So for an early stage, for a large corporate perspective, it really would be in 2-3 ways. Either you do a joint development, So here is an idea, here is a new ingredient or a process, know-how.
New material.
And a new material. And we can work, when I say we, it's a large corporate can work closely with the startup to help on aspects like optimizing the formulation itself, getting the regulatory approval, the dossier to for if just as a case, if it cases it's a novel food,
Yeah.
So they have the expertise, the lawyers, they have the background.
The EFSA, all the processes.
Exactly. They can help with the processes. But then as a startup, you need to really consider, do you want to give up your IP? We'll come to an IP part also early enough, or do you want to work under a joint development, create a joint IP, and then still retain, maybe offer the IP to that particular corporate which is supporting you for a particular application or for a particular geography, and then you still hold the rights for that application for the geography elsewhere in the world.
Right.
Yeah, and then you can say, or you.
So picking your battles. I think this is something that a lot of people might stir away from CVC because they fear two key things. One is being associated with one brand can cut contracts to another brand. Yeah. So the whole part of making sure that whoever you side with either isolates a part of your market so that the rest is still free, or you're taking a bet that it's going to be them and they're going to be 90% of your offtake, but that's the bet you're taking. Yeah. And the other aspect, of course, is the IP. What do you have to say about the IP part, especially when you're a founder, maybe young founder, you've done this for your PhD. It's a passion project. And suddenly, as big as the company is, and it might be an honor to work with, we mentioned Amcor, we mentioned on Nestlé, of course, we mentioned Unilever, but that's just to stay in food. Any large company, it's great to work with them because it gives everything you mentioned, but the idea slides away from you. How is it that founders can get the most out of it and work from equal to equal, so it doesn't feel like one is trying to screw the other, which is one of the dynamics that a young founder doesn't have the lawyer army than the CVC has, and it can feel very imbalanced. So how do you recommend a founder to approach those relationships, feeling that it remains equal, trying to get the best out of the David against Goliath, and vice versa?
Yes, but then I would really challenge also the founder. What is their real strategic interest and motivation? Do they want to be running this company for next 25, 30 years of their working life? Or are they looking for an exit in 5, 10 years, which is also the case because once an entrepreneur, always an entrepreneur. Some people see themselves as serial entrepreneurs.
Yeah. You exit and you restart.
You exit and you move into something completely different. So if you're you're planning an exit in the next 10 years or so, it's not a bad thing to go into a particular application, a scale up, and a particular geography with a large corporate. You generate the revenues, there are numerous examples. Once you get into a 100 million kind of a revenue, then you could be acquired for $1 billion, 10 times multiple.
Right.
There are even recent examples. So the last 2-3 weeks, there are examples now of large companies saying that, this has the revenue potential and we will pay good money. It's not a bad thing, but if that is your motivation, if you want to be.
So there needs to be an alignment from the get-go. So that's maybe more of a founder philosophy thing. As a first-time founder, here I'm speaking from experience, we did take some money from CVCs. We had money from BTV, B2 Venture, which is the CVC of British American Tobacco. And we had some money coming in from Gordon Food Service. So their sub-branch Relish Works, which I would love to have on the show, and working on that. Taking CVC money for us was nothing limiting in terms of the market, because we felt like we got a good deal out of it and everyone was happy. As a founder, it can be terrifying to get into this. And you said, okay, the way to not be terrified about it is to align with it. When you're talking about an exit, it feels like it's miles away. You're working every day and say that what we call the fire, you always have to extinguish something. There's always a problem happening. It's very hard for a founder to take a step back and project himself in 5, 10 years. What are the things that you could advise, or things that you've seen with companies you invested in, that founders can do to get this idea, to be able to project themselves? How do you do that exercise? Is not something they teach you at school. Is maybe not something they teach you in accelerators even, or incubators. The exit is often put aside, and sometimes it's a bit of a taboo. If you talk about an exit in the very early stage, some investors might think, wait, they just want to come and go, and is that really who I want to go with? How do we demystify, how do we untaboo the exit, how to approach it?
I think even as investors, when you first hear your founders presenting, and if there is no clear exit plan, at least I'm very suspect, you've not thought through then. You are talking of the growth, you're talking of the potential, share of the market, revenue, etc. Great projections, but what do you really want to do at the end of 10 years?
So you'd be pushing to have an investor talk about the exit, even in the first, in teaser deck, something like this.
Exactly. Ask what is your plan? And many a time it's not just a founder alone, it's normally founder and a founding team, co-founders.
Sure.
Are they really aligned? If they are a team, have they really thought through where their lives will be together, 10 years down the line and or more or less? Recent example, as I said, in 3-4 years, people are doing exits and reasonably good exits. Now it's really a question of how fast it can be that you reach, I don't know, a revenue of 100 million. This is a kind of a benchmark today. But yes, it also comes down a bit, I would say, to personal personality and motivation and the team dynamics inside the company, inside the startup. Because when you are 3, 4, 5 people, it's one thing. As you grow even to 20, 25 people, and we have experience in this ourselves in DDF, beyond 10 people, it's a different dynamic. It's all the things that you talk about. What are the challenges working in large corporate? Very soon we see it in the startups also. The moment they are about 10 people, full-time employees.
Gotcha.
You need to put structures and organization, and bureaucracy somehow steeps in. And then it's really a question of the drive, the motivation of the founding team, or in which direction they really want to go.
I see. So I think now we want to tackle the differences between, we mentioned a little bit about the CVC world, so I'm very happy. Now let's try to move to VC and the key differences that you see between the two. CVC has a very direct, very straightforward, very clear idea. If it benefits the mother company, chances are you're going to get backing because you also have the direct support with regulation, etc. When you think as a VC, you don't have this mother company, you don't have this. You have a thesis, but the thesis only depends on the founding partner's ideology. So a CVC can support a company. It's very hands-on. As a VC, what can you bring more than just money? We often hear VCs saying we are, for example, an impact fund, and we will help you because we're an impact fund. And it's actually been very rare that I hear founders saying, my VCs are great. They helped me doing this. They found me this client. What do you think is the true potential that a VC has? Is it really exploited to its full capacity, or do you think there's improvement to do in the VC model, maybe inspired from the CVC world? And is that something that you're trying to bring in from your CVC experience to DDF?
Yeah, with CVC, what I would say is that, in recent times, the churn has been a bit too much. What typically happens is the CVCs are set up with a certain mandate, with a certain investment thesis, etc. 3 to 5 years, even 3 years, I would say. Most people who set it up are moved on. They move in the company, they move into other positions. The new guys come in and they sometimes challenge for good or bad reasons, and sometimes completely shut down or completely take a different direction. And then the founders who start to interact with that team, the team doesn't exist anymore, or it's moved into a different department. And the larger the company, the more complex the entire situation is. Now, to your question on CVCs on VCs adding value, I would say we are a bit different because we are not only financial investors. We come with the industry experience. That is true of me and and what we really do is we challenge because we understand the categories, that we invest in. We are not pure people who run financial numbers on an Excel and say, yeah, this looks good and let's invest here. We understand the category, we understand the technology. We have had both technology experience and the commercial experience. And then on the side, we have picked up the finance experience to say this would really work.
Of course.
But then we can really add value to the strategy of the investee company and challenge the founder on certain assumptions, which pure financial investors don't. We can challenge them only on the financial assumptions, but not the others. But we can challenge them. But on the other hand, we can also open doors into new geographies through our network. Each of us, we have had 25, 30 years industry experience across geographies and industry sectors, and in the value chain of the suppliers, of the raw material, ingredient guys, downstream retail, packaging, all of this. So we can open doors.
Can you maybe run through what this looks like in a real company? Is this something that happens in the board meetings? Is this something that maybe in your own thesis, the way you work with companies is that you meet at least once a month to run through maybe the business model, the revenue model, check the pricing, etc. How does this actually translate? You say you have this understanding of the industry. How do you translate the industry into actionables for the company?
We think of an investee company as our own passion project.
Right.
We were with founders. This is the kind of business we would like to create and run. But it's good to now have somebody else operationalizing it. And you're right. Obviously, our board position is interesting, but even in the board dynamics, it's not really. No, you could be a large ticket institutional investor or sovereign fund, which has taken the large investment into a minority stake in the company. But for them, it's really a pure financial investment. They don't really add value into the strategy, into the operationalizing of or the scale up of the company. Whereas people with industry experience can actually challenge and open doors and give good strategic advice. And then it's for the founders really to pick it up and say, yeah, this makes sense. The founders also choose to work with VC funds which can add value. So it's one thing to have say, yeah, here is the ticket coming in, reject it. If I'm on the founding side, founder side, is it adding value? Sometimes you need the cash, but you also need the additional support.
That's a bit of luxury because usually the founders take whatever money comes to them. Only rarely, if it comes to them, it's a very good sign. But when they are oversubscribed, then they can start picking, I want to go with that fund instead of this one because there's the additional. It's not always like this. Most of the time, founders, they're on the brink of death and they just take the money. How does a founder select the right funds? But at the same time, they don't shoot themselves in the foot by saying no to other types of money because, they don't have enough additionality. Now we're actually tackling the core of the podcast, which is really about fundraising. So now we're talking about fundraising strategy. How much importance do you give to finding the right investor before starting the outreach, before just peppering emails and spraying emails all around to all kinds of investors. It's a bit like job application, I feel, where you only send 5 applications, but they're very targeted. You get to meet them, the whole warm introduction path, you know their nationality, rather than just sending your deck to 200 funds. Is that something that you would put a massive emphasis on?
Yes, and I really think what has been good successes are people that we have known for a while. It's not just one pitch at one new startup competition pitch. You get to know a normal investment process could take easily 3 to 6 months, but even then you don't really know the people. I think we have just been fortunate in our team. We have had long industry experience. So some of the companies which are in our short list and are currently doing due diligence in our deal fund, what we would invest in is that we have known those people personally over, if not multiple years, but at least for a while, for a reasonable period of time, and know and understand the category, know and understand the people, the key team members and questions, and you see those paths that where they are today, we believe they have the potential of the technology and the scale up and the people behind to make it grow.
So this is a further emphasis on for the audience, especially founders out there. You do not raise money when you need the money. You start way before this whole network. And there's nothing wrong going to an investor and not necessarily pitching to raise right now, but just saying, hey, I'm out there, I exist. This is where I am today. But I understand I'm not necessarily ready right now. But showing the mental clarity and having that maturity to say, look, I'm not ready yet, but let's start building the relationship. I think that there's a lot of similarities between getting with an investor and love relationship. There is first you meet, you have a couple of dates, you get engaged, and then only you get married. So you need to follow the whole thing. You can't just come with the rings ready and say, hey, will you marry me? Wait a minute, I need to know you a bit more.
Absolutely, there was. You can flirt for a while.
Yes.
That process can take, and yes, then you have multiple dates. And then you get into, the formal relationship. I would also be, if I'm a founder, I would actually be also a bit skeptical if people are coming in with checks and wanting to invest very early without a due process. It just means then it's easy money, and when the times are good, and right now, yes, definitely everybody agrees because of geopolitics and things around the world, it's not the best of times, inflation, the oil crisis, nothing is settled yet, so
for sure.
So this will continue for a while. It's not only a short run, but it's going to be a medium run. But the currency fluctuations, which geography you are in, so that fundraising times are challenging at the moment.
Getting a bit longer.
This also means that there is opportunity in this crisis. This is the time to build your relationships, your networks. So when you are ready and when you are and you have the right people, and the right people will always take your calls. And whereas, as I said earlier, when it's easy money, then it's almost a FOMO, fear of missing out. Investors want to go in, and that has also led to these collapses of some of the startups which got funded very early, too much with high valuations,
and the later rounds
come in and
cannot justify the new valuation.
But then even in that, there is also an opportunity because now there are down rounds, and if you believe this will work in the near to medium term future, then it's also a good time to be investing.
I see.
Yeah, it's a bit of a contrarian theory, but it always works. Yeah.
I see. I think we had a big talk about all of those different types of funding. We mentioned a little bit about IP. I think a lot of the things that you mentioned about IP with CVC also applies to academia. You mentioned you work with a CIRIS. So those are academic spin-outs.
Yes, exactly. So in the agri, it's particularly that's linked to the University of Cambridge, the agri spin-outs, etc. But I also see a lot out there. If you're a research scientist, it is a challenge to be seen as a good founder and somebody who will, very few will make it to the next stage, really.
Right.
Because their interest really is pure science. If you are in pure science and this is what you would want to do, reasons you want to make the world a better place, you are focused on your science, but very quickly you need to work in a team and you need to find people with the
co-founders
who will complement your own skills on the science part with commercial sense, know-how. And industrial scale-ups, it's just a bit far removed. So university spin-outs is a great thing.
Because it de-risks the tech a lot.
Yes, and they are well protected. They have the support of the academia. You can register your patents, etc. Make it big in real life and practice in the real world.
You need to detach.
You need to detach yourself. And actually, it's not a bad thing because many of the researchers want to focus on the science. They take a backseat themselves, so
willingly they will be just head of science, head of technology,
exactly,
and lend the growth to someone else they trust.
exactly. Bring commercial officers,
Right.
even a CEO if needed, and you yourself move on to your next research project, etc.
Is that something that you immediately test? Is that one of the top things you test when you have a founding team of engineers, of really technical people, whether they are going to be willing to take that step back? Or I think there's probably a lot of technologies out there that were wasted with founders that are the only ones to have the knowledge, but they don't really want to let their baby go away, and they stay and it blocks the company. How do you deal with that? How do you detect it early on, and how do you work around it? Do you just think, hey, I don't have the time, hard pass? Or do you work on this? Do you try to implement advisors? How do you do that?
We have different tools, government funding, for the initial grants, etc. Then you prep, you build a relationship, you can advise them informally as well, if it's not serious VC money coming in yet. And it's also linked a bit to the geography. Where do they want to really expand, and where the thing is, and do they want to give up their position in the academia? So some just want to double hat, they want to continue in the world of research and academia and support some spin outs, but also exit early, and but just be continue as a chief science officer or the CTO of the organization of the company they have founded, but let it grow on its own steam with other people, other people, other investors and all. So
those are topics we tackle early
we
with the technical founders.
Exactly. And some reach out, some see also the profile of people who are just doing, is it just a technology assessment? And it's not at this stage, they are not even, in a VC world, they would not stand even the initial pitch, they are they're not trained for that, but they're deep on the science, So then you also need to really see, are they willing to detach themselves from the pure, the passion for the science behind?
Conscious of time here, we'll hop to the faster question segments. I feel like that's also a good way, like a medley, to get as many songs out there. So are you ready for the this or that?
Good to go.
Very easy. You have two options, option A, option B. You tell me, and I'll write down the answers. So 3, 2, 1, CVC money or VC money?
VC money.
Founding a fund or founding a startup? What do you prefer?
Founding a fund.
Warm introduction or cold email with a killer deck?
Warm introduction.
Even with a killer deck?
Yeah.
Deep tech with weak go-to-market or strong go-to-market with an average tech?
Strong go-to-market with an average tech.
Board seat or observer seat?
Depends. I'm happy with a board observer seat as well. It's actually a bit simpler. Anytime, more pragmatic.
I think this one we already mentioned, but solo founder with a strong advisory board or co-founders with no advisory board?
Co-founders complementing each other. The advisory board can be optional.
University spin out or corporate spin out?
That's a tough one. If there's no other background, I would say a corporate spin out.
Operator turned VC or academic turned VC? Which one is a better investor?
Operator turned VC.
All right. That is for this first segment. So you said they're not easy questions. They're designed not to be easy. So I'm glad you said that. University spin out and corporate spin out, you say was the hardest one to pick, but you said if there's no other background with it, corporate. Why is that so? Is it because there's more market to it and more backing? Maybe more to do with the supply chain versus the university where the tech is super strong, but everything else is to build around it?
I would say with the corporate, it's probably they have had some commercial experience. It's real world. Academic could be interesting, but probably in sectors that I'm not familiar with. If it's pure tech and somebody can run the next algorithm or
Gotcha. CVC versus independent VC. You picked VC extremely quickly. What made this decision so fast and no hesitation?
Because the underlying objectives are better aligned with VC. A VC would run a bit more broadly and then go deep. It'll be a T kind of a thing. You look at the landscape more broadly and then where you invest in, you go a bit really deep. Where the CVC, the underlying objectives are still the corporate objectives,
And they can be very broad.
They can be very broad and they are aligned too. So a CVC is run by an employee of a large corporate.
Yeah.
The employee's own objective is to continue with the career progression, get the bonus for the year.
Whereas the VC is the founding partner
is in for the next 10 years. As I said, very simply, more involved. A CVC person who's currently the employee of the CVC is on a board. Will have a 3-year view. And the 3-year view is linked to his or her personal objectives of the bonus and the next position in the corporate. A VC will stay with the company at least 8, if not 10, invest today, hold the position, make the company grow and exit. And the personal objective is also linked to the success of the company.
Right.
It's not linked to the overall return. But yeah, it will be.
So an advice for founders who would take CVC money would be to not only depend on one person, but try to de-risk their own source of funding by having maybe more contacts. So if one person leaves, you're still in good terms with the others and you make sure that everyone is aligned, right?
Exactly. And also your own objective of receiving the CVC money is for what? To do a joint partnership, take it an off-take agreement, do a commercial partnership. Those aspects we discussed earlier. It's not the only aspects for the growth of your own company. It should be just one angle for how your company will grow. But don't put all your eggs in the same basket. Unless you want to exit very early, in which case also it is suboptimal for you yourself as a founder and for the company and the team that you have built.
The last discussion point on this first fleet of questions, operator turned VC versus academic turned VC. Again, you picked operator. I suppose it's because they understand more what the company is going through.
They look at multi dimensions of the founding. Right. An academic could be a super strong professor in finance, and he or she can run numbers very quickly or run very closely on the technology, but would not have the breadth of experience needed to be a successful VC partner.
So the picture that seems to be drawn here is that not only for companies where, as you said in one of the questions, co-founders that are complementary to each other, it's also valid for VCs. A VC cannot be just a bunch of finance bros, to put it like that, or ex-IB, or just a bunch of ex-founders, or just a bunch of ex-academics that maybe, I don't know, they're academic in a field, they spun out something, and then they made their money and don't want to invest. Variety and diversity in the fund is also a massive green flag.
Of course.
Gotcha. All right, let's get ready for the second fleet of questions. This time it's yes or no. Some say it's simpler, but sometimes it's a bit harder. So we'll see what we've got in here. 3, 2, 1. Should founders always ask an investor, what would make you say no in the first meeting? Is it a good question to ask?
Yeah, why not?
Is a warm introduction still meaningfully better than a strong cold outreach in 2026?
Maybe I'm old school, but yes, I still believe so, yeah.
Should founders disclose that they're talking to other investors?
Yes. Thing is, most VCs don't take the entire round. You're always syndicating it. You can also always, and that's also one of the value add as a VC you can bring, and a co-founder should be looking out for. Can you also trigger a syndicate and get other investors in?
Right. Is a 20 slide deck too long for a first email?
Depends on the number of lines in each slide.
I like this answer.
But yes, I mean, 5 slides is also doable, but so long as it's easy read and gets the points across, yeah.
Should impact funds sacrifice IRR for impact?
This is the tough one in this round. There's a stated objective of impact, sustainable finance. But without IRR, it will not be sustainable, as you said at the very start of this podcast.
Leaning towards no, I would guess.
Yes, I guess so, yeah.
Should founders take CVC money in their first round?
In what form? It's a question. Giving up own equity, large equity, very early is I would say suicide, because the company, you will never grow it. You have already given out.
Large, you mean anything above 25%?
Yes, I would say. There are other ways. You can look at convertibles. You can look at a joint development agreement. Not always do they only need money in equity. You can get revenue from doing a pilot project. You can do a project and get the revenue in.
Is the pitch deck still the most important document in the fundraise?
I would say yes, because people's attention is divided. You can make a TikTok video and 30-second video and say, this is my company. Yes, it depends on your audience, but you still need, the thing is, it's not just one person, even in a VC, You will receive it, you will share it in the team. How do you share it in the team? Will you forward an audio clip, a video clip? Will you share a sample,
Yeah. So formatting is evolving.
Formatting, it's a look, as I guess in any communications training, they will tell you, consider your audience before you put your message out. Yeah.
And the very last question, are you having a good time?
Yes, of course. That's why I'm here.
Beautiful. Thank you so much. I think, usually we do those questions and then we discuss them. I feel like we already started to discuss them within that. So a bit more editing for us to do behind the scenes. The IRR question is where there was a bit of friction, because you can't really sacrifice IRR. So what if I turn the question around? For an impact fund, can you sacrifice impacts for IRR?
No, but then you're not an impact fund.
It sounds obvious like this, but
it's also a question of, are you getting a lot of, let's say, public funding, taxpayers' money to fulfill a mandate?
Okay.
But then you leave it to the public sector, banks, the public entities. It's their job. Right. It's their job because they measure it in different ways. If you can You can make an investment, you can then provide tax breaks, you can provide employment into the region, this kind of a thing, but it's not us. I mean, that's for really for public entities to do it. But for us, we need to, that's why, ESG investing, Article 9 investing is tough, it's challenging. You need to do good for the planet and the people, but you need to generate the returns for the investors for you to be taken seriously. For the investors to say, yes, it's making the impact and it's sustainable. It's not a subsidy. There is no subsidy. The business has to stand on its own feet and you need to return.
I'll drop in a last question in there that just came to me. Have you ever been in a position where there's a business coming to you and you feel maybe the impact is not actually as good as they say, so it doesn't really qualify within your thesis, but the business itself is really good, you believe into it? Would you ever stir away from the thesis for just that one specific investment because you see the vision behind it? Or is that something that maybe you would take just as an angel investment yourself or a syndicate outside of the fund?
We would consider, can we add value? So if it's not making the impact, can we add value over the next 5-8 years that we would hold the investor? If we can make a significant change, a pivot in the model, in the technology, can we add value? Then yes, why not?
By value, you mean an impact value or just value in
By
general?
the impact value. But can we steer it in a way that this is doing good, but
that it fits back in the range?
It fits back in the range. So we need to have the flexibility there.
Vivek, thank you so much for your time, for all of your insights. Is there any topic we maybe didn't tackle today that you would like the next person to talk about, or maybe you can even nominate someone else that you believe would be a great guest on the show with a specific topic?
Happy to think through. I mean, all of this has triggered some thinking in my own head, and it was a pleasure being here, but I'll come back to you.
Perfect.
For more candidates and for more topics.
Really appreciate that. It helps with the growth of everything. I hope
so much. More power to you. I mean, I think we need more and more in the ecosystem that we are in, or let's say, people like you who can see the different angles from different perspectives, from different players.
Beautiful.
Thank you.
Thank you so much.
Good
Cheers.
day. Bye-bye.